Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. GDP numbers coming hotter than expected, showing us that the economy is still firing on all cylinders. Or is it? Fed hikes interest rates another quarter point, despite inflation coming down, trending down for over the last year. So let's just dive right under the hood and let's figure out what this means for your investments and your money. Let's just start with PCE data that came out this morning, another inflationary data metric that the Fed loves to highlight each and every Fed meeting. Let's take a look on your screen there, and the core PCE is the one that Mr. Powell, Fed Chief Jerome Powell, likes to highlight. Core PCE was expected at 0.2%. What did we get? We had 0.2%. What does that mean? It means it came in as expected. The Fed was expecting this to be the number, yet they hiked interest rates again, and they have been hiking rates. We had our first pause last June, but they've been hiking rates since March of last year. Inflation started coming down roughly in June of last year. And we've had a hiccup here and there where inflation's ticked back up because markets usually don't go down in one direction and they don't go up in just one direction. It's more of like a trend up and down, but trending in one direction. Trend right now has been trending down, but the Fed is hiking rates. Why are they doing that despite inflation coming down? Let me show you something that we need to keep this in our mind. It's very important for us to understand this, to figure out what the Fed's going to do in the future. All right, I'm going to put this on your screen here, and it is the Fed's purpose. The Fed has a dual mandate. The Fed has to bring price stability, and the Fed has to bring maximum sustainable employment. All right, what does that mean? Price stability means that prices need to, we can't have massive inflation where prices are going through the roof because no one can afford 8, 9, 10% inflation year over year. So we've, as a society, or as the Fed has stated, their mandate is to bring inflation down to 2%, bringing price stability. Because without price stability, we can't have sustainable employment because no businesses, people that are retired, consumers can't afford a massive amount of inflation. So if you listen to what their press conferences, what Mr. Jerome Powell said during his press conferences, each and every meeting is their main objective right now is to bring price stability, is to bring down inflation. Not only bring down inflation, crush inflation. And they're going to keep raising rates until they've met their restrictive enough policy. Now they've said it's been restrictive enough, but they're still hiking rates. And why is that? Because inflation doesn't go down in a straight line, and if it ticks back up, they don't want to be fighting this later. So they're going to bring this down. And at the same time, unemployment's been low. But if you watched our video a couple weeks ago, pre a bad time in the market, unemployment's always very low. So as employment stays low, they have the ability to raise rates. And until it starts picking up, unemployment starts going up, that's when you'll see a downturn in the economy following that quite quickly, within like a few months, historically speaking. So the Fed right now has one objective, it's to crush inflation, and they're going to keep doing that as long as the job market holds up. And I want to show you guys another thing here. Let's take a look at, put this up on the screen, crude oil energy prices. With crude oil energy prices, you can see over the last month here that we've had an uptick of 13%, a little over 13%. If you look at other commodity prices, copper, lumber, your metals, they're up 5+% for the month of July. So we're starting to see, despite them raising rates, we're going to see little upticks in inflation, and the Fed doesn't want that to come back. If it starts going back up, then they're going to have to be fighting that later in the year, and that'll bring that'll be bad news for the markets. That'll bring they'll lose faith in what the Fed is capable of doing. So the Fed has to defeat inflation. They have to defeat it definitively, and that's what they've set out to do here. So that's why they're raising rates, and despite it going down. Now, Our opinion here is really that they're going to keep raising rates until they break something or until unemployment really starts to shoot up. And once it starts shooting up, folks, unfortunately, it really doesn't slow down until we get some kind of downturn cycle. So given this, so they're going to probably keep hiking rates. Why is the stock market and asset prices still going back up? Because the markets don't really believe the Fed is going to keep hiking rates. I mean, you look a couple meetings ago, the markets didn't even believe they were going to hike rates this meeting, yet they did. So let me pull something up on the screen here. Let's check this out. What I have here is the probability of the Fed raising rates in the September meeting. And you'll see here, right now, the Fed's rate is below that. You'll see 525, and that translates to 5.25%. Between 5.25% and 5.5%. That's where the Fed funds rate is sitting as of today. And you'll look at the probability of the next meeting of them raising rates, it's only at like 25%. That's the market's expectation. The market expects at like a 70% probability that the Fed isn't going to hike rates in September, even though we've had a good GDP number, even though we've had better than expected jobs numbers because inflation keeps coming down. But the Fed, all it takes is one little poor inflation data point, a little uptick, and you can see by the number, the crude oil, commodity prices, that's a real possibility. And they may just do it just because the job market's holding up. So, have a plan for what the Fed is going to do. We have jobs numbers next Friday, and I think that's going to give us some more information. Is the jobs the jobs market starting to crack? If it's still remaining strong, the Fed has the excuse they need to keep doing what they're doing, fighting inflation, and going to cause us some pain later because of the tight monetary policy. We're a credit economy. Banks aren't lending. So we'll keep you updated on how you can navigate this mess of a storm that's potentially brewing, despite everything looking good right now, despite us being in this window of clear skies. So tune in next week, and we will talk about what the jobs number is doing and what it means for your money. Expertise you deserve, experience you can count on.